welcome to another episode of our Property and Finance podcast. Today we have a very special guest. We have a VIP of research, you could say. We have Tim Lawless, the head of research at CoreLogic. Tim comes with over 17 years experience there at CoreLogic and over 20 years in the industry and in the space, you could say. So Tim, welcome aboard.
G'day, Theo. Thanks very much for the invitation, mate. I'm really looking forward to having a chat.
Yeah, thank you. Thanks for your time. I know you're a man in high demand, as we said earlier, and you have events like this and conferences all the time where you're sharing your wisdom and your thoughts to the ever-changing. And that's probably where we'll start today. Why don't we sort of get your view on I guess, a snapshot and a summary of the current economic landscape in the property market as a whole, the local economic landscape and the global sort of outlook. You know, you being at CoreLogic, you've got data at your fingertips, and you're probably seeing some of this data before it gets released, right?
Well, absolutely. From a property perspective, I don't get any preview to the economic data. Of course, it generally comes out of the Australian Bureau of Statistics or RBA, whatever. But I mean, broadly, the trends in Australia aren't that much different to what we're seeing around some of our comparable Western nations. Most markets around the world are coping or struggling with the same challenges we are around high inflation. And even though inflation's coming down across most jurisdictions, it's that last mile, that last sort of, getting services inflation back down into the target range is really proving quite difficult. Of course, that's probably the key thing everybody's waiting for here in Australia is another confirmation that inflation's coming down towards a target range, which gives us a hint that interest rates will eventually start to come down as well. In fact, today, just before you and I caught up, Theo, the ABS put out their monthly inflation indicator, which once again has come out a little bit higher than we were expecting. So it does look like this last mile of inflation is going to be quite the challenge. And I think we'll find more economists are pushing back their rate cut forecast to maybe even next year.
Yeah, so that's interesting. All eyes are going to be on the quarterly data, though, right? The monthly indicator isn't as in depth as the quarterly data that's released in July. Is that right?
Yeah, it's not the full basket, so good point. But it does give us a little bit of an inter-quarter update. And, I think a bit of a hint that the June quarter, when we eventually see it, I think it's released sometime in July, maybe August, a bit of a hint that it's still going to be probably a little bit higher than what the RBA was comfortable with. Whether or not it's tracking against their forecast is going to be the key thing. And hopefully we do see inflation in the March quarter bounced back up to 1% from 0.6% in December. So hopefully there's another reduction from that March quarter number. But at the moment, it's certainly looking a little bit risky.
So you just called out something earlier that I just want to sort of go back to and expand. It's the services section of the inflation sort of data that's coming out. That's the concerning data. Goods are coming down, but services not so much. And that's probably correlated to wages somewhat, right?
Well, to some extent, services inflation is really being driven by things we can't pull back on our spending. Most of this is non-discretionary. So things like healthcare, financial services, insurances, rents, of course, are a real driver of inflation as well. So with wages, wage price growth has been pretty strong, although it looks like it peaked at the end of last year. It's a little bit over 4% growth. It's now coming down a little, or decelerating a little, which is great. Well, it's probably not great for you and me, but everybody wants to get paid more. It is good news for inflation. But the unfortunate reality is most households have really pulled back hard in their spending. Retail spending numbers have been really weak, quite soft from month to month and quarter to quarter. But the reality is what's really driving inflation is no longer consumption driven. It's more about things that are very much outside of what we can pull back our spending on. There will be a little bit of a mechanical lowering in inflation thanks to some of the budget announcements like energy rebates, some concessions for better incentives for renters, that type of thing. But there is a chance that extra money could then go into further spending, which in my view is probably unlikely.
Yeah, so we saw some retail spending data actually come out this week, sort of to your point, the discretionary items like department stores and whatnot are quite weak. Sales are low, but the non-discretionary items, the services, and I guess household expenses are still high. To your point about the inflation and speculation, maybe that a rate rise might not be off the cards quite yet, because if this next quarter of data shows that inflation is still sticky, we could expect that August rate rise, August being the first opportunity after this quarter of inflation data is released in July to react to that data news. We saw the Judo Bank economists come out and talk about potentially 3 more rate rises this year, which I think is probably not likely, right?
Yeah, well, yeah, never say never, of course, but that seems pretty bearish. But then again, Warren Hogan, who's the economist you're referring to, is really well credentialed. He's got a very good track record as well. Financial markets are generally betting on, we're done with rate hikes. The next cut, though, will probably not be until April or May of next year. The big four economists, or economists from the big four banks, are all still penciling in November for the first rate cut. So I think that diversity just really speaks to the sheer uncertainty around the inflation trajectory and what the RBA's intentions might be.
So then let's transfer this into what you're seeing. How does this correlate to the data of CoreLogic on the property front? We saw the start of this year, there was some good volume of listings and stock as such, which were also linked to good sales, good clearance rates and decent prices, right? But then more recently, has that eased off, I believe?
Well, we're definitely seeing property prices are still rising in most markets, and this is despite high interest rates and cost of living pressures, really low levels of consumer sentiment. So it does seem like really low supply levels against what seems to be fairly average to above average levels of demand are trumping those other downside factors. And you're right, Theo, we've generally been seeing listing numbers, even though we've seen a pickup in vendor activity, most of that is being absorbed pretty quickly. If you look at a rolling 4-week count of new listings coming into the market, we're seeing that tracking a little bit above 10% compared to the same time last year and above average, but total listings are still below average and below what they were a year ago. So it does look like demand is holding pretty high despite such high interest rates. And you could probably help to explain that as well with just rental markets being so tight alongside high migration. That's where the demand's coming from. Probably a lot of spillover from rental demand moving into purchasing activity if they have the financial ability to do so.
Yeah. So even though we had increased supply was being met with demand. And now even with an easing of supply, it's still some strong demand despite higher interest rates, right? It is surprising. I have to say, last year I personally didn't have such a bullish view. I was probably more of a bearish view toward the property market going to 2024, because I thought that crippled borrowing capacities and stretched households might mean some more distressed sales and affordability would be capped. But it's stayed quite buoyant and strong, and the economy has proven to be quite resilient.
Yeah, I mean, the economy is resilient. You look at GDP numbers, at least up to the December quarter, it's remained positive. Clearly, there's been a slowdown in economic activity, but quarter to quarter is still positive. We're avoiding a technical recession. But look at the GDP per capita numbers, and they've been in negative territory over the past 3 quarters. They'll probably be negative for March as well. So I think for most of us and most of your clients and your borrowers, they're probably feeling like they're in a recession, even though the technical numbers say we're not. Hence why everyone's pulling back pretty hard in the spending, trying their best to save. But even the household savings ratio is down around sort of the 3% range. We haven't seen a saving ratio that low since the global financial crisis.
There's a lot of similarities to the GFC, to be honest, as we're seeing now in terms of economic data. We'll just talk about the cash rate. We haven't seen a cash rate this high since the GFC, really.
It's 2011, I think the cash rate was last this high, and it's actually a good comparison point. The last time we saw interest rates this high, household debt levels were sort of 15% lower than what they are now. Housing debt levels are about 18% lower. So it just highlights that the household sector is a lot more sensitive to rate hikes now than what they were the last time interest rates were this high. And I think most households are just really trying to weather the storm. And you'd have to argue the longer rates stay at this elevated position, then we probably will see more evidence of rising mortgage arrears and some level of stress emerging.
Yeah. So you have some of the foresight to that data internally at CoreLogic, right? What are you sort of seeing internally in terms of household pressure?
Well, we can definitely see, we talked about the retail numbers. Households are pulling back in their spending wherever they can on non-discretionary side of consumption. You can also see it in the mortgage arrears numbers as well. So mortgage arrears through the pandemic fell to record lows. Like hardly anybody was running behind in their mortgage repayments, mostly because interest rates were so low, but also there was quite a bit of forbearance coming out of the banking sector through a global pandemic. And of course, they had a lot of backing from the federal government as well, through the term funding facility and so forth. But what we're seeing now, of course, is the 90-day arrears rate is consistently rising. It's still a little bit below what it was pre-COVID. I don't think that's going to last much longer. So you're looking at, across the whole mortgage portfolio, around sort of 0.7, 0.8% of borrowers would be moving into an arrears situation now. So that's still pretty low given the high cost of living pressures and high interest rates. But I wouldn't be surprised if it goes higher than that, particularly with this higher for longer scenario that most economists are now thinking for interest rates.
We're probably expecting it to go higher, right?
Yeah, that makes sense.
And what has been the sort of historical average on that figure of arrears for, let's say, the last 10 or so years?
Yeah, so the data comes out of APRA, and generally we see mortgage arrears in Australia holding below 1%. Even during the global financial crisis, we hardly saw mortgage arrears moving upwards. They got sort of around the early ones. Even in somewhere like WA, post-mining boom, we saw mortgage arrears holding below 2%. So most Australian borrowers, they do everything to keep on top of their mortgage repayments. They'll bend over backwards to stay ahead of their repayments and keep their home.
Definitely.
And I think lenders in Australia as well are very different than what you might find in the US. All lending in Australia is full recourse, and the banks hold this debt on the balance sheets rather than securitizing it. So, they take their risks seriously. And I think that's probably another really good testament is just the standard of lending in Australia is very high, which is probably another reason why arrears are contained.
Yeah, APRA has done a great job of scrutinising lending policies for a long time. Even though some lending policies were introduced back in the GFC, prior to the GFC, there was sort of tight lending policies that prevented our economy getting to a state like the US did with, borrowing over 100%, let's say, sometimes on a purchase for a property. So there's been good practices in place for a while that keeps a bit of a robust, healthy system.
Yeah, absolutely. I'm just looking at some APRA numbers now, and the portion of loans being written on loan-to-income ratios that are greater than 6 times was only about 3% in the December quarter. That's the most up-to-date numbers. Loans with a debt-to-income ratio of more than 6 times was only about 5%. High LVR lending has been consistently trending lower as well. So what APRA would describe as the riskier styles of lending have really become quite a small portion of lending. Part of that's just policy. Part of it's just a cautionary appetite from lenders, I think.
Well, also, you're right. Part of it is policy. We've seen since the Royal Commission some DTI, debt-to-income ratio caps be enforced on the banks and subsequent consumers, where you can't really borrow above 6 to 7 times your household income that easily. And there's other things they look at, like, is a lot of this income rental income and not too much is professional income. There's various things that they make sure keep the household in a good shape. One of your colleagues was on our podcast not too long ago, Eliza Owen, and she was talking about the lag effect on some of this data, like arrears. So you mentioned the 90-day arrears data. it takes another quarter to actually report on that 90 days arrears, right? So some of that stuff that we're looking at today is actually from 6 months ago. Is that right?
Yeah, absolutely. So recall there's a lot of focus on the fixed rate cliff, for example, around this time last year. The peak in that was about June or July of last year. And since then, we've generally been seeing mortgage arrears, again, holding pretty low. But as you say, Theo, it takes 3 months to get into that 90-day arrears basket. But it probably takes longer than that as well to fall behind in your arrears rates as well. It is cumulative. So, yeah, let's see what the future holds. But I think to our earlier conversation, I think we'd be naive to think arrears aren't going to rise further from here, but from a very low level. And I think even ultimately, say a year from now, we'll probably find arrears are quite contained, at least from a global perspective.
So let's talk about the property market again as a whole and maybe what you're seeing there. So we just released our recent State of Sydney report. It's a quarterly report which we analyse some CoreLogic and various forms of real estate portal data to look at trends and forecast growth. It's been quite accurate when we've compared forecasts to actuals in the past. It's the report that got us on to the 2GB and 9 News. This week we released it, and there was a few various media publications that reprinted the article, like the Australian Broker and the Real Estate Journal. And we got some surprising feedback where people didn't even realise that there were certain markets still strongly growing at the moment, right? So there's still a bit of a mixed bag of news out there in the sense that some markets are growing, some are staying steady and stagnant, and some are probably decreasing in value. We're seeing some land sort of subdivisions. The land itself in certain markets on the outskirts of Sydney is being sold at lower prices than we saw maybe a year or two ago. But then again, some of those areas like that southwest growth corridor past Camden, Campbelltown Way is still growing aggressively, right?
Yeah, it's so important that the headline numbers are one thing and they tell you a macro view. But when you start to drill down, you're exactly right. There is a lot of difference from market to market across the product types. So as a really broad example, we're seeing much stronger conditions across the middle to lower end of the market in Sydney. Go back a year ago, and it was very much the upper quartile of the market that was leading the growth cycle. It does look like, with borrowing capacity has reduced, affordability is becoming more challenging. And as we talked about, lenders are generally more conservative. That probably is skewing demand towards that middle to lower end of the marketplace. And we can definitely see it in our numbers. So sort of that outer fringe of the market, a little bit better than your inner city, higher end markets. But also units, once the poor cousin to houses, are really starting to show a stronger growth rate, not just in Sydney, but around the country as well. And I think it's the same thing where the lower price points and this renewed level of activity from first home buyers and investors does seem to be fueling stronger demand and stronger price growth across that sort of middle to lower end of the marketplace.
Well, that's another great shout. I'm glad you highlighted that. We released a blog post about this about a month or two ago, talking about the growing disparity between unit prices and house prices. And I think during COVID and even post-COVID, people really chased buying a home. I think they were craving space. And I think there was also some data released about how each household now on average has less people living in it because some people are working from home and they need now a spare bedroom for their home office. So people are, working from home, chasing a bigger home as such, being land with potentially a backyard. But that growing disparity then puts value on opportunity in terms of units. If they're a big difference in price, look more appealing, and maybe someone can go get a 2 or 3 bedroom unit instead. And that's generally what happens in all trends of property, right? So to the point about some markets performing and some markets not, the ones that are probably now remaining steady or stagnant compared to the ones that are growing are the ones that are steady and stagnant, the ones that have increased aggressively in recent years, and the ones that are performing didn't do as well, would you say?
Yeah, I think those markets that did see a lot more growth through the pandemic are probably reaching a bit of a ceiling in their affordability capacity. Just to give you some really high-level numbers, talking about houses versus units, through the last 4 years, roughly, so since the onset of the pandemic back in March of 2020 through to the end of April, so 4 years and 1 month, we've seen house values across Sydney are up about 34%. So pretty big jump. Or in dollar terms, that's about $369,000 increase. It's huge. Unit values are only up 9.3%. It just highlights, this through the pandemic, there was this real aversion to density. More people wanted space. And as you say, Theo, more people were sort of disaggregating their group households, looking for home offices, wanting more space during lockdowns. That was probably fair enough. But now I think we're seeing a real reversal of that, where lower price markets and units are shining through because they are much more affordable. And at a time when affordability is challenged and access to credit's a bit harder, then it makes a lot of sense to me.
And that's why we're seeing other markets like Perth and Brisbane still sort of have consistent growth because of affordability reasons, where people are now moving to these cities as such, where they can still maintain a similar employment or the same employment and get a bigger home as such, right? It's affordability reasons and chasing value.
That's a big part of it, absolutely. The typical dwelling value in Perth, for example, is about $720,000. Compare that to Sydney, it's about $1.1 million. A bigger difference for houses. You can still buy a house. The median in Perth is about $753,000. In Sydney, it's pretty much double that. It's 1.4 million. So you can understand, having cheap housing is one thing, right? People don't go to somewhere just because they can buy for really cheap. Otherwise, you'd find everyone going to Darwin. But the economy is another big part of it. So somewhere like Perth or Brisbane, generally strong economies, really strong interstate migration flows as well. Plus, they've got relatively affordable housing. So it's that recipe of economic conditions, migration patterns, and housing that all sort of interact to drive prices higher.
And there's a bit of a misconception, right, that it's just these. There's a bit of a mining boom in some of these cities. That's not entirely the case. In Brisbane, right, the economy itself is thriving with businesses actually relocating, big companies, public listed companies moving their head offices and whatnot there. So the actual CBD is thriving, right?
Yeah, absolutely. I mean, these economies have quite a bit of depth to them. Even somewhere like Perth, that sure, WA is still quite skewed towards mining and resources, but there's some massive infrastructure projects underway that are mostly transport related. Queensland's got a booming healthcare industry. We've got the Olympics, 10 years away now. So a lot of infrastructure planning ahead of that. And each of these cities as well is just going through, like everywhere in Australia, is going through this significant undersupply. There's just hardly any residential building activity underway, at least compared to what's needed. So it's that undersupply is another key factor pushing prices higher.
There's undersupply in those cities as well, would you say, in Perth and as Brisbane? Because I know we've got a massive supply issue in Sydney. Even despite the fact that unit prices haven't really jumped much locally in Sydney, we're still seeing unit prices. I mean, we're still seeing a lack of supply, right? But I believe markets like Brisbane, there's definitely a lot more supply, right?
No, not necessarily, mate. It's this undersupply situation is evident everywhere, and it's the same sort of factors. It's this previous surge in materials costs, so inputs to construction like steel and structural timbers. Input costs increased about 30% through the pandemic for a whole bunch of reasons: supply chain, capacity issues, and so forth. And even though the rate of growth in construction costs is now much more normal, it's not going backwards. So margins have been significantly compressed pretty much to nothing. And now we've got builders really contending with a shortage of trades and labour, competing with non-residential and residential projects for the same trades, which are in scarce supply. So pretty much wherever you look around the country, there's this shortage of newly built housing. And if you look at the earliest phases of new supply coming into the market, which is approvals, everywhere is holding below average and not showing any real signs of starting to lift.
But the approvals have somewhat turned around, right? We can sort of forecast approvals and future supply, and I believe that did bottom out recently and it's starting to improve.
Yeah, so bottoming out is probably the best way to describe it. We've seen approvals generally find a floor, again, well below average. A little bit of evidence that maybe it's just starting to pick up a little bit, but nowhere near as much as what we need to see to reach. Remember that the federal government has a 1.2 million well-located homes target over 5 years. To achieve that, you need to be seeing, 20,000 approvals a month. Currently, we're seeing about 14,000 approvals a month. And the longer you undershoot that mark, the more catch-up there needs to be as well. So, even though we may have seen approvals sort of level out at fairly low levels, we need to see a lot more activity before we're getting even close to a run rate that's going to achieve that target.
And that's why we're seeing a lot of government initiatives and actions to try and address that supply. We're seeing record migration with a focus on skilled workers and trades to try and help bring builders into the country, you could say. We've even seen modular homes now be accepted in these house and land subdivisions. I can't even believe that there's modular builds for apartment blocks. There's a whole new era of building sort of happening these days where they might build 100 units out of a modular factory, right? And then the state government locally, once again, New South Wales, I thought was a great initiative that that whole subdivision of one block into a duplex, let's say, or two townhouses. The state government had their policies that they would release over the years, but their local councils had their overarching policies that would sometimes sort of kibosh or prevent these policies from being implemented in certain marketplaces. But there's been some changes with that as well, where we're seeing now that state government will have the overarching sort of policy in New South Wales, at least. It will overrule local councils, and there's a bit of an uproar by councils about that matter, right?
Yeah, we're seeing that in other jurisdictions as well. WA, again, is a good example. They've had their JDAP program where the state can override local town plans to ensure that strategic density is being approved and going ahead. Exactly the same as now what we're seeing in New South Wales. And I think we'll see more of this. I think every layer of government is going to be under intense pressure to meet housing supply targets and do what they need to do to get more supply into the market. I don't see that relenting at all. In fact, you'll probably find there's going to be a lot of other announcements and stimulus packages aimed at getting more supply into the market, to the extent that, maybe 5 years from now, we're in a marketplace that might have too much supply, especially given we've moved through the peak in migration and population growth will slow down from here. Australia does have a habit of the pendulum swinging both ways a bit too far. So maybe that's a risk in the medium term.
So let's just stay on some of these other markets like Brisbane, Perth, and even potentially Adelaide, because a hot topic at the moment, we're seeing record amounts of people want to purchase an investment property in these marketplaces, especially because some people, let's say, have been priced out of Melbourne or Sydney to buy a home. So they do the rent vesting sort of strategy of purchasing an investment property whilst they sort of accrue more savings and wealth as such to then maybe one day crystallise those profits and buy a home. We've seen this trend of people buying investment properties in these other marketplaces for a long time, and there was speculation that maybe this growth in certain marketplaces like Brisbane and Perth isn't sustainable, but it has been sustained. We've seen Brisbane have the highest population growth the past decade, right? So that's just going to keep prices going. The question is, for all our investors that are thinking about this strategy, what's your sort of view and forecast for, I guess, the next 5-10 years ahead in these marketplaces? Is that demand going to continue? Is there enough of economic growth in these cities like Brisbane and Perth for that price growth to be maintained?
Theo, I'll be the first to say, 10 years from now, nobody knows what's going to happen. Even 5 years from now, I think is hard. Maybe 1 year from now is hard. But I think, Southeast Queensland does stand out to me as having a lot of opportunity. Declaring my bias, I'm a Southeast Queenslander, so maybe that's shining through. But it does seem to be a region that's become much more popular. It always has a positive rate of interstate migration. And at the moment, even though it's not quite at record highs, it's come down from the pandemic highs, it seems to be settling at well above average levels for the interstate migration flow, which tends to correlate a lot more strongly with housing, like purchasing demand, than overseas migration that tends to flow more into rental demand. So yeah, I'd look at Southeast Queensland, especially with Olympics down the track. There's going to be a lot of investment, a lot of capital flows coming into that region. And it still has a fairly affordable price point compared to Sydney. Not as much. The difference between Melbourne now is hardly anything. They're virtually neck and neck in terms of the price points. Perth as well, I think at least the short to medium term prospects in Perth are looking really good. Again, it's a very affordable market. It's got a strong rate of interstate migration flow. I think the economy is going to be quite strong for some time. Sure, it's a little bit riskier with the dependence on the resources sector. But it's also got very high yields as well. So for investors looking for that mix of potential for capital gains as well as some opportunity for a higher yield, Perth really ticks that box as well. And then maybe from a bit of a roughie, if you will, Melbourne is starting to look a lot better now. And a lot of investors seem to be avoiding Melbourne for the obvious reasons. It's very high taxing. It doesn't have a trajectory of capital growth at the moment. Yields are generally quite low. But if these conditions persist for a little while, which they probably will, it probably means Melbourne's really establishing or building up a silver lining of affordability, higher yields as rents are still rising quite quickly. And maybe that's somewhere to be positioning at least over the next couple of years, because I think Melbourne probably will come good at some stage, especially if that gap between Sydney and Melbourne prices continues to widen. We haven't seen a gap this wide between Sydney and Melbourne prices for 20 years. So, it does suggest Melbourne's looking a little bit better now, at least for a long-term strategy.
So let's stay on this topic of investing and what sort of investors are looking for in these various marketplaces. You called out yields. So Sydney, unfortunately, probably has the lowest yields out of any city in Australia, right? Where units are slightly higher, but still not that much better than houses locally. Other marketplaces, to your point, like Perth, what are we seeing? I've heard rumours of 7-8% yields on some houses or apartments after purchase, not too long after.
That's pretty extreme. Like Sydney's got a yield of 3.1%. I'm talking gross numbers here, so it's hard to provide a number for a net yield, but if you take at least a percentage point off. Sydney at 3.1%, Perth, second highest yield around the country at 4.5%. You go to somewhere like Darwin. I mean, Darwin has a yield of 6.5%, but it's still a pretty risky market. I think that high yield is compensation for the higher risk. But to your point, Theo, if you're buying into some of those more affordable markets around Perth, areas like around Canning or down at Mandurah, getting a bit further north around Wanneroo or so forth, Swan, then your yields are going to generally be quite a bit higher. And these are some of the strongest capital gain markets as well at the moment. So
crazy.
It is some pretty startling numbers here. But I think you'll find the yield profile in Perth is going to diminish pretty quickly. I mean, rents are rising quite quickly, but we're seeing value growth in Perth that's averaging about 6% quarter on quarter. So it won't be too long before that starts to compress yields in that market.
Yeah, so that's sort of probably going back to some of the data we're seeing from our clients who are dealing with these sort of investor-focused buyers agents or buyers advocacy businesses that are finding these opportunities. And I can't believe what we've seen in those outskirts of Perth, let's say, where prices, capital growth has been evident. You're talking maybe property prices almost doubling in 4 or 5 years, and then at the same time, really attractive yields. To my point about chasing value and finding markets of opportunity, generally a market like that, for example, if it had such great growth and rental growth, it's probably tapped out now, right? I know you can't give a 5 to 10 year forecast, but at least over the next few years, can it continue?
Well, yeah, I definitely wouldn't describe this rate of growth as sustainable. You've seen Perth housing prices are up about 22% over the past 12 months. In dollar terms, we're seeing Perth housing prices just on a monthly basis are rising at about $14,000 a month. So no, I don't think it's sustainable. And arguably, some of these areas around the outer fringes of Perth these are also the areas you generally attribute with higher levels of supply down the track once we do eventually see a supply response as well. So the timing would be really important. Once we do eventually start to see some supply coming into the market, these are the same areas that will probably be the beneficiaries of that supply, but arguably that would be putting some downwards pressure on prices when it eventually happens.
All right. So if we want to bring it back to, I guess, not just these markets, but the property market across the country in general, which is hard to say something in general, but if we want to give the Tim Lawless crystal ball sort of forecast and what you think homeowners or future buyers should look out for in the next 6 to 12 months, rates higher for longer is the one expectation that we've clearly been forced to digest by the media is one thing. But what do you think we'll see over the next 6 to 12 months in these various marketplaces?
Yeah, well, I think from an economic perspective, we should expect there is going to be a slowdown. So expect to see economic growth slowing. And as I mentioned, avoiding a recession, but it feels like one. Labour markets will be loosening up. Inflation, hard to get down below into the target range, but probably we'll get there sometime next year. And ultimately interest rates coming down, although the timing, I'd probably be putting that somewhere in the first half of next year, hopefully. Property markets, though, I think are still being dictated by very low supply levels. And this is going to take some time to change. We talked about a lot of the hurdles of getting more supply into the marketplace around compressed margins, high lending costs. Commercial lending is still quite conservative. Builders are finding it really hard to find labor, and supply materials costs, even though they're not rising very much anymore, they're not falling either. So supply is going to be the real challenge of getting into the marketplace, which probably does imply further upwards pressure on prices. But over the medium term, given the government's focus on a fairly significant supply response over the next 5 years, you'd have to think that's going to happen, at some stage. So I think that's probably the risk point is maybe 2 or 3 years down the track, we do start to see finally some more housing supply coming into the market, which could paint a higher risk profile for some of those outer fringe, more greenfield styles of housing markets, maybe some of the inner city or transport node oriented higher density markets as well. They're the two sort of broad precincts where you'd expect there eventually to be a supply response. Investors looking to sort of protect their assets, you're generally looking for markets that can avoid some of those supply risks, like well-established markets, closer to the city, closer to the coastline. Those sort of areas that have some inherent scarcity associated with them, you'd have to think, even though they have higher price points, will probably be the markets that show some longevity over the long-term horizons for investment.
That's a really good point. Something that hasn't been called out on one of these podcasts or episodes in the past. So, areas obviously where there's limited supply, limited development, whether it be houses or subdivisions or units, right? There's many marketplaces where it's not that easy for a developer to come along and build a big apartment block. But you're right, on the outskirts of all these cities, we've seen, mass amounts of house and land subdivisions happening sort of left, right and centre. And they're probably going to be the first to go in a bit of an uncertain time, especially if supply does increase and there's more and more added in these outskirts. They're the more volatile markets to watch.
Yeah, I think that's probably a fair assessment, although probably the counter argument, or at least a little bit of positivity for some of those areas, is that's exactly where people are going to be buying as well. It's affordability is going to be affordability challenges are going to be with us for some time. And I think for first home buyers, for a lot of investors, these are the markets they'll be targeting simply because that's where they can afford to buy.
Is it crazy, though, what they're getting in? Let's say, I keep referencing Sydney, but that is my backyard, so I do know the prices and whatnot. But, in areas like Leppington and Austral, which are probably going to be some beneficiaries of that new airport, land prices are still quite strong just for vacant land. They're talking, the smaller blocks were getting 2,000 thereabouts per square metre for maybe 350 square metres of land, vacant land. And it came back a little bit, but it's still sort of $1,700, $1,800 per square metre. To my point that I was referencing in Campbelltown, Camden, around that sort of south corridor, which is not far from Austral Leppington. They're bigger blocks, but they're still getting, sort of 1,800 a square metre, and then you've got to build a house that starts at maybe 400 or 500 grand on top of that. So most of these people are in for 1.5 total. Still, a 400 square metre block of land for maybe a 400 square metre block of land for a 3-4 bedroom house, all up for 1.5. It's still value in Sydney.
Yeah, and that's the reality. I think to deliver new housing, like we talked about, is there's a real premium on it now. And I think a lot of builders are going to be waiting for the established market to catch up to where that premium needs to be. And that's where the profit margins will eventually start to restore themselves. But at the moment, it's pretty tough putting new stock into the market, especially from medium to high density, where just finding the right price point that the market will tolerate at the moment just don't allow for much of a profit margin at all, which is why we're not seeing much activity in that sector.
So is there any more, just before we sort of wrap up this episode today, Tim, is there any more sort of interesting data that you're seeing that probably hasn't been spoken about in the media? We've seen, we've all heard about the vacancy rates, but from an investment point of view, are we seeing an uptick at least now in investors? I feel like I said, we're seeing internally, are we seeing more people inclined to purchasing investment property given the landscape for investing with low vacancy rates, increased rent, historically increased rent, and higher yields in certain marketplaces? Are we going to see anything like that change soon for tenants to be able to find homes?
We're definitely seeing investors becoming more active. In fact, if you look at the lending data from the ABS, investors have shown the biggest jump in activity over the past year. The value of lending is up about 31%. So in some markets like Perth, it's up more than 60%. So and Victoria is a lot lower. So we're definitely seeing investors targeting those markets as showing a fairly strong appreciation trajectory and where the price points are a bit lower. Melbourne or Victoria does seem to be on the nose a little bit. I'd probably put that back to a combination of just the high tax environment, a bit of a hangover from the pandemic, and relatively weak demographic trends outside of the overseas migration component. We're definitely seeing investors becoming more active. A real turnaround from a year ago when investors, I think, were a little bit cautious and we only just started to emerge from that very short and sharp downturn during the
They almost disappeared. Yes, that's a positive sign, at least for the housing market in terms of rentals. And to my point I touched on, historically we saw some increase in rent, but it's sort of tapered off now. We're not seeing rents rise as aggressively, right? If anything, it's maybe been a bit of an easing as such.
That's right. We're certainly seeing a little bit of an easing in the rate of growth. Rents definitely not going backwards. In fact, most cities are still seeing rents rising, somewhere between 5 and 10% per annum. So that's still a pretty aggressive rate of growth, but it's nowhere near what we're seeing through, sort of 2021 through to 2022, which is more like 15% per annum growth. So I think a lot of renters are just simply getting to that level where they can't pay more rent. You can't come to Shore Financial and get a loan to pay more rent, right? So there's not a great deal of elasticity in how much renters can pay. So I think for a lot of renters, they're either looking to maybe rebuild their group households. They're looking at some more intergenerational styles of living, so multiple families in one household. They might be trying to maximize their tenancies or look for something cheaper, like a unit rather than a house or something out in the burbs. You can't expect rents to continue rising as rapidly as what they have. And the updated rental concessions in the federal budget, I think that might give you an extra $15 a week or something like that. It nowhere near covers the level of rental growth that we're seeing.
Now, speaking of the federal budget, I don't want to talk politics with you today, but do you think there was some good initiatives in that federal budget that's going to make a difference to any of these things that we've spoken about today? Yeah,
there's a lot in the budget about housing, particularly around things like trying to stimulate more supply. That was a given. We're also seeing a lot more funding for social and community housing. A lot of that comes out of the state budgets, but also there is federal funding for that. We also saw a lot of infrastructure spending announcements as well, another $16 billion of infrastructure spending, which is important when we have such a rapidly growing population. We need to make sure we're building the roads, the schools, the hospitals, and so forth as well. In terms of some household relief, there was also some announcements that around energy rebates, some better rental benefits as well. So that should help to mechanically lower inflation. But again, there's a little bit of risk there that extra cash in people's pockets could be spent and drive inflation higher. But my gut feel tells me it'll probably be spent on essentials or saved where it can.
Yeah, there's a bit of a mixed bag there. Definitely a focus on improving housing supply, and then the cost of living crisis, that $300 does help a lot of households. So I think some good will come from it, and none of it should be inflationary, right? So a lot of people were speculating whether some of the stimulus could cause further inflationary pressures, but I don't think that's the case. Do you think?
Well, there's still some speculation that could be the case. But yeah, like I said, I think most households are going to be either spending that on things they need to be spending it on or saving it where they can. So hard to see it being inflationary when we already have this cost of living crisis.
Yeah, there's already sort of pressure in an average household.
Yep.
All right, Tim. Well, thank you so much for joining us today. It's been a pleasure to have you on board. I think you and I have spoken at industry events here and there, but this is the first time you've actually joined us on our own podcast. So I hope maybe in 12 months we can invite you again and we can review the year that was and maybe have that new forecast of the year ahead at that point in time. So thank you so much for coming on board, Tim.
Many thanks, Theo. It's been fun. Look forward to the next time.